could it be now? Knocking up my T. Ticker AT&T, guys. That is on the New York Stock Exchange, telecommunication services, sector, industry, wireless telecommunication. And this is the monthly candle chart, guys. The AT&T. Let's see where we're at. Monthly defined. Resistance. Monthly defined support. And here we are, guys. A lot of noise. When I see these wicks, a lot of wicks, a lot of noise, intra. So during the weekly, the daily, the smaller time frames, usually the monthly is very good at reducing the noise. So when you're on the monthly, you look at the bodies and the wicks, they're telling you the volatility on the smaller time frames. But you always close, always do your trend lines. Support, resistance, monthly defined is on the closes of those candles, greens, reds, and that's what the market decided that was super important. You want that close to be above or below certain levels. And then when I see a lot of wicks, that means during the day, during the week, sellers came in and then buyers came in to bring the price back up above those break lines. Not my favorite type of stocks. All right, where's the trend? 12-month average going downwards. Price action going downwards, declining. And now we're forming this top formation right here. Implied measure move. I had to close below that breakdown line. Pull back up. That support turn resistance. Didn't make it. Down you go. That would have been a good risk to reward entry right there. Where's my next support? Over here. So sometimes when I have targets that go through important monthly defined support, and even here, right there. Either I got greedy with my swing rule, and then I like when there's like the harmony when the swing rule goes close to a natural support line. So when I went through it, either I would cheat if I'm going to be doing stage analysis in just my regular chart trading framework, I'd bring up the target up here and I put my profit limit right there to make sure I get triggered out before hitting that congestion zone. But if I'm doing stage analysis on the weekly, I know that I have a swing rule that's going to bring me down to there, but I could expect pullbacks hitting, here's that 12-month average probably going downwards, hitting that monthly defined support, expect pullback there, and then after that I would continue, and that would give me another entry right here, possible entry to short again, continuation short all the way down here. Same thing here, natural support, 12-month average. If it's still going downwards, then you could have another bounce here. Then you bounce off this support turn resistance, what I call a wall, and then you continue until price action closes back above the 12-month moving average, and then that's your final sign to get out of there. But as long as you're below 12-month moving average, what you're going to try to do is you're going to try to find good risk-reward entry, protected by support and outturn resistance, protected with a close 12-month moving average that you bounce off and it starts going down. And you're going to use the Mansfield relative strength on the weekly. You never want to short if the Mansfield is gaining. That means you're starting to outperform the SPX, or you're gaining steam on the SPX performance. You have to wait for that. You want to wait for that Mansfield to start resuming its decline. It's underperforming against the SPX, and then the lull right here. See right there. Starts going back down. Then you get that good risk reward entry right there. What's on the weekly, guys? See all that noise above the 30-week moving average? You have to exit because Yeah, you shouldn't be the trader's way. You definitely should not be in a stock if you're above the 30-week moving average. Very, very hard to hold. That's why you go on the higher trend on the monthly chart. And if you want to avoid all that noise for a noisy chart like that, you want to make sure you have the power of the monthly chart saying it's going down. So you have that velocity. So you have those pullbacks instead of going all the way up and busting the 30-week average. If you're on the right side of a breakdown on the monthly candle chart, these pullbacks should be less and less threatening to the 30-week average. They should get close to it and then get pushed down and give you the better chances of remaining in that stage 4 decline and not get whipsawed. This is not the best. You don't want to be, that's not a A++ stage 4 decline. It's messy. This is a nice stage 2. See, it's short, but at least it's nice. Above, sideways move, not really threatening the 30-week average. Up, sideways move down, and then you would bail when you violate that worst case scenario. Break, close below that 12-month moving average. Retest, continuation down. So this was optimal right there. We missed it. And then you had another break here below that consolidation pattern on the weekly chart. So right now, there's not much to do for entry. We're in a stage 4 decline. We're going to wait for that bounce off that monthly defined support and maybe bounce off this consolidation pattern here on the 30-week moving average, close to the 30-week average, and then we'd have another chance to go down, guys. But until then, you're going to have to let this free fall. You're kind of far away from the 30-week moving average. You could probably maybe take half position, wait for that price action to go back down, and then another half wherever it decides to pull back. Look at that, the volume, red volume, lots of damage. Red volume, damage, especially, it's not just a red volume, it's a red volume, but with a high percentage change, 11% change in the week, going down. What about this one here? Another one, 6% volume candle down. Red, damage, damage, damage. This has not been outperforming the SPX for a long time. Stage 4 decline for AT&T continuing. Monthly candle chart. Confirmed breakdown. Next support all the way down here on the monthly defined support. 22 level, long way down. And if you play on the weekly, oh man, all these scribbles, Pat, the scribbles. Hold on. Remove all drawing tools. Okay, go back just to my monthly line. Patrick, you're so messy. I had 22. There you go. About. Okay, go back on the weekly. There you go. Right there. All right. You could take half a position here. If you would enter here, half position here, your sell stop above the declining 30-week moving average. Position size not to lose more than 1% if ever it comes back all the way above here. Or half position, don't lose more than 0.5%. And then this could be the expected move right here. 30-week average keeps going downwards. Pull back close towards that breakdown line. Support turn resistance. And then if it's on contracting volume, you know the game. That means that pullback was a simple pullback and not a reversal. And then after that, you could continue all the way down. So that is classic Stan Weinstein stage analysis, playing on the breakdown, playing on the pullback. That's it, guys. All right, AT&T, man. Join the stage 4 meltdowns. Ciao, guys.